Imagine you're sitting in a sun-drenched office in Sunny Isles Beach, Florida, back in early 2023. You're looking at a man who has spent 50 years being the scariest person in any boardroom. This is Carl Icahn. For decades, his name alone could make CEOs break out in a cold sweat. One phone call from him could send a company's stocks soaring or crashing. But here's the shocking part. In just a few weeks, this man would watch $15 billion of his personal fortune simply vanish. You probably thought billionaires at this level were untouchable. It feels like they play by a different set of rules, right? You watch as he moves through his day with the confidence of a king. He's the original corporate raider. He's the guy who inspired the character of Gordon Gekko. But even kings have a heel. And Carl's was about to be stepped on. You have to wonder, how does a man who built an empire by finding the cracks in everyone else's business miss the giant crack in his own? To understand the fall, you have to look at the legend. You trace his history back to the 80s. Back then, Carl didn't just invest in companies. He took them over, stripped them down, and sold the parts for a massive profit. You see it clearly in the story of TWA, the legendary airline. He bought it, loaded it with debt, and sold off its most valuable routes. It was ruthless. It was efficient. It made him a billionaire many times over. He eventually rebranded himself as an activist investor. It sounds a bit friendlier, doesn't it? But the game stayed mostly the same. He'd buy a big chunk of a company and start making demands. He pushed Apple to buy back shares. He fought a legendary televised war with Bill Ackman over a company called Herbalife. For years, you noticed that the market treated him like he had a Midas touch. If Carl was buying, everyone else wanted in. This brings us to his main vehicle, Icahn Enterprises, or IEP. This wasn't just a company. It was a master limited partnership. You see thousands of regular retail investors pouring their savings into it. Why? Because it paid a dividend that seemed too good to be true. We're talking about a 15% yield. In a world where banks were paying pennies, Carl was handing out dollars. It made him a hero to the mom-and-pop investors. But there was a strange tension building in the numbers. While the stock price stayed high, the actual businesses Carl owned weren't always doing so hot. You notice a massive gap forming. The company was worth way more than the sum of its parts. On Wall Street, they called this the Icahn premium. People were paying extra just to ride on Carl's coattails. Finance people still go back and forth on whether that premium was ever justified by real math. Some say it was just the price of admission to follow a genius. Others argue it was a psychological bubble waiting for a needle. As you watch the calendar flip to May 2023, you realize that the needle has a name. It's a small research firm called Hindenburg Research. They don't care about legends. They only care about the math. And the math they found was about to set Carl's world on fire. It's a quiet Tuesday morning in early May. Most of the financial world is just finishing their first cup of coffee and checking the pre-market numbers. Then a link pops up on social media. It's from Hindenburg Research. You probably recognize the name by now. They are the demolition crew of Wall Street. They don't just write reports, they hunt. And this time, they have the biggest trophy imaginable in their crosshairs. The title of the report is brutal. It calls Icahn Enterprises a glass house and suggests that the legendary corporate raider is finally being raided himself. You watch as the PDF spreads through trading floors like a digital wildfire. Hindenburg isn't pulling any punches. They claim that Carl's company is overvalued by more than 75%. They argue that the math used to value his private businesses is basically a work of fiction. Imagine you're one of those mom-and-pop investors we talked about. You bought into IEP because you trusted the man. You loved that massive dividend check that arrived every quarter. But now, you're reading words like Ponzi-like in a professional research report. The tension in the air is thick enough to cut with a knife. You refresh your screen and see the stock price. It's not just dipping. It's cratering. In a single day, the stock price drops 20%. That is billions of dollars in market value simply evaporating before lunch. The report highlights a very specific, very uncomfortable mechanism. Hindenburg points out that IEP was using money from new investors to pay out those juicy dividends to old investors. It's a classic robbing Peter to pay Paul scenario. To make matters worse, they reveal that the company was trading at a massive premium to its actual holdings. It was like paying $100 for a wallet that only had $20 inside. There's still a real disagreement on whether the company's dividend structure was truly Ponzi-like or just an aggressive way to reward long-term holders. Some analysts at the time argued that as long as Carl could keep raising capital, the wheels would keep turning. But Hindenburg changed the math. They didn't just point out a flaw, they broke the spell of invincibility that had protected Carl for 50 years. You notice the mood shift instantly. On Wall Street, reputation is everything. For decades, Carl was the guy who could bully the world's biggest corporations into doing what he wanted. Now, he's on the defensive. He releases a statement calling the Hindenburg Report self-serving and misleading. He tells everyone to stay calm, but the market isn't listening. The Icahn premium is turning into an Icahn discount. And by the end of that first week, the numbers are staggering. We aren't just talking about a bad day at the office. We are talking about a $6 billion haircut to Carl's personal net worth in a matter of days. It's a high-stakes game of poker, and for the first time in his life, someone has called Carl's bluff. You see the panic starting to set in among the retail crowd. People who thought their retirement was safe are now watching their principal melt away. The legend was bleeding, and on Wall Street, once people see blood, the sharks usually aren't far behind. Here's the thing about being a billionaire. Sometimes your wealth is more like a giant house of cards than a solid gold bar. As you watch the stock price of Icahn Enterprises continue to slide, a new and much scarier detail emerges from the fine print. It turns out that Carl hadn't just been running the company. He had been using his own shares as collateral for massive personal loans. This is what Wall Street calls a margin loan. Think of it like taking out a mortgage on your house to buy a boat. But in this case, the house is his stake in the company, and the boat is, well, more investments. Reports at the time showed that Carl had pledged over half of his shares, roughly 60%, to secure these loans. This was the hidden trapdoor. You realize that if the stock price falls to a certain level, the banks don't just ask for their money back. They take your shares and sell them automatically to cover the debt. This created what traders call a death spiral. You can see the logic clearly. The Hindenburg Report makes the stock price drop. The drop triggers a potential margin call. If the banks start selling Carl's shares, the price drops even further. It's a self-fulfilling prophecy of financial ruin. For a man who built his career on being the one who dictates terms, being at the mercy of a bank's automated trading algorithm must have been a bitter pill to swallow. The tension in the following weeks was palpable. Every time the ticker moved down another dollar, you could almost hear the gears turning in the offices of big banks like Morgan Stanley and Bank of America. They were the ones holding his markers. You trace the numbers and realize that at its lowest point, Carl's personal net worth had plummeted from about $25 billion to less than $10 billion. In the blink of an eye, $15 billion had simply vanished into the digital void. Analysts still argue about whether the banks were being way too reckless by letting one man have that much leverage against a single stock. Some say it was a classic case of too big to fail on a personal level. Others believe the banks knew exactly what they were doing and were happy to collect the fees until the music stopped. Either way, the oversight was clearly not as tight as everyone assumed. Imagine the phone calls happening behind the scenes. You picture Carl, a man famous for his grit and his gravelly voice, negotiating for his life. He wasn't fighting a CEO this time. He was fighting the math. To stop the bleeding, he eventually had to move his loans around and provide more collateral. He basically had to prove to the banks that he was still good for the money. But even as he stabilized his personal loans, a bigger problem was looming for the company itself. The Icahn premium was gone, and the investors who had stuck by him were starting to get restless. They were looking at that 15% dividend and wondering if it was a gift or a time bomb. The corporate raider had survived the margin call, but the foundation of his empire was cracked, and the world was watching to see if he would do the unthinkable. Cut the payout that made him a hero to the little guy. For years, that $2 quarterly dividend was more than just a check in the mail. It was the Icahn promise. It was the reason thousands of regular people kept their money in his company. You could ignore the falling stock price as long as that cash kept hitting your account. It was a massive 15% yield. Most companies would struggle to pay out 4%. Carl was doubling, tripling, and quadrupling that. It made him look like a financial wizard who had finally figured out how to beat the system. But in the summer of 2023, the magic show finally ran out of smoke and mirrors. You notice a change in the air during the August earnings call. The numbers were in, and they were grim. The company had lost hundreds of millions of dollars in the second quarter. The pressure from the Hindenburg Report was mounting. The banks were watching. The math simply didn't add up anymore. You can imagine the tension in the room when the announcement finally dropped. Carl did the one thing he had spent years promising he wouldn't do. He cut the dividend in half. Just like that, the $2 payout was gone. It was now just $1. To a regular investor, this was like a cold splash of water to the face. The stock price reacted exactly how you'd expect. It didn't just slip, it fell off a cliff. Within minutes of the news, the stock dropped another 25%. It was a bloodbath for anyone who had held on through the initial report. This was the moment the Icahn premium officially died. The legend of the unbeatable raider was replaced by the reality of a struggling investment firm. You see the charts from that week, and it looks like a mountain peak turning into a sheer drop. People weren't just selling because of the money. They were selling because they felt betrayed. The man they trusted to protect them had just cut their income in half to save his own empire. Economists still debate whether cutting the dividend was a sign of total surrender or a necessary move for survival. Some say he should have done it years ago to keep the company healthy. Others argue that by cutting it so late, he only proved that his critics were right all along. It's a classic debate over whether it's better to look strong or actually be strong. In this case, Carl chose survival over the image he had spent 50 years building. The fallout was messy. You noticed that the total loss to Carl's fortune had now crossed that staggering $15 billion mark. Imagine losing that much money and still being a billionaire. It's a scale of wealth that is hard to even visualize. It's enough cash to buy every single person in a mid-sized city a brand new car. And yet, it was gone. Just like that. The dividend king had been dethroned by his own balance sheet. You start to see the shift in how the media talked about him. He wasn't the hunter anymore. He was the one being analyzed and picked apart. Every move he made was now viewed with skepticism. Even his loyal followers were starting to look for the exit. The momentum that had carried him for decades had completely stalled. But if you know anything about Carl Icahn, you know he doesn't go away quietly. He still had one more fight left, and this one would involve the federal government. Just when it seemed like the dust was finally settling, another storm rolled in. This time, it wasn't a short seller with a research paper or a group of angry retail investors. It was the government. The Securities and Exchange Commission, or the SEC, had started asking some very pointed questions. They wanted to know why Carl hadn't been more transparent about those personal margin loans we talked about earlier. When you're the head of a public company, there are strict rules about what you have to tell the world. If you've pledged half your company as collateral for a private loan, people generally think that's something they should know. In August 2024, the news finally broke. Carl and his company agreed to pay $2 million to settle the charges with the SEC. Now, for a man like Carl, $2 million is basically pocket change. It's what he might spend on a nice lunch and a flight. But the money wasn't the point. The point was the official stamp of disapproval. The SEC's findings showed that he had failed to disclose the full extent of his share pledges for years. It was a major blow to his reputation as a straight shooter who looked out for the little guy. Finance people still go back and forth on whether this settlement was a slap on the wrist or a serious warning shot for the rest of Wall Street. Some argue that the SEC was just doing its job to protect transparency. Others believe the government was making an example of a legend to show that nobody is above the disclosure rules. Either way, it marked a definitive turning point in his career. You notice that Carl didn't admit or deny the findings. He just paid the fine and tried to move forward. But moving forward is hard when you've watched $15 billion of your net worth disappear in the bright lights of the public market. The world of Wall Street had changed right under his feet. In the old days, Carl was the apex predator. He was the one who bullied boards and broke companies apart. Now, a small team with a few laptops and a Twitter account could take him down. It's a completely new kind of a power dynamic. You watch as he tries to pivot back to his activist roots. He's still out there making moves and taking stakes in companies like JetBlue. But the fear factor just isn't the same. People don't run for the hills anymore when they hear he's buying in. They look at his balance sheet first. The story of Carl Icahn and Hindenburg Research isn't just a story about a bad trade. It's about the moment the hunter finally became the hunted. It shows that even the most legendary giants have a weak point. All it takes is one person willing to look past the legend and focus on the math. Carl is still a billionaire, and he likely always will be. But the $15 billion he lost is a permanent reminder of what happens when you get too comfortable. He forgot that in a world of sharks, there's always a bigger fish, or at least a hungrier one. The story of the corporate raider being raided himself is one of those classic Wall Street tales that stays with you. It's a reminder that the markets are the ultimate equalizer, regardless of how many decades you've spent at the top. It really makes you wonder how many other untouchable legends are just one bad report away from a similar fate. I'd love to hear your thoughts on this one. Where are you watching this from today? And what's the economic vibe like in your neck of the woods? Does this story change how you look at big name investors? Or do you think this was just a temporary stumble for a man like Icahn? Drop a comment below and let me know what your plans are for navigating these crazy markets. If you enjoyed diving into this story with me, it would mean a lot if you could hit that like button. It really helps the channel out more than you know. And if you want to catch the next deep dive into the wild world of finance and economic history, make sure to subscribe and turn on those notifications. There's always another story hiding in the numbers, and I can't wait to share the next one with you. Thanks for hanging out and listening. I'll see you in the next video.